Here's the situation. You want exposure to AI and software innovation, but you don't want to pay $400 a share for it. So here's the good news. There are actually plenty of low-priced stocks out there that have excellent upside potential. It just takes a little extra digging to find them. Gladly, I started your homework for you. Today, I've been sharing 4 high-potential tech stocks, all trading for under $15 a share as we're recording today. That's not their only attractive feature. Each scores highly in the Zen Ratings quant model, which distills 115 factors that point down to stocks most likely to outperform. On top of that, insiders have been actively buying shares in all these companies. As most people know, there are few signs more bullish than management buying even more of their own shares. And by the way, I'm Steve Reitmeister. I was editor-in-chief of Zacks.com for nearly 20 years, and now I'm currently a partner at WallStreetZen.com. After 40 years of investing, I know a thing or two about locating high-quality stocks, and I'm happy to share some of that expertise with you today. If you like topics like this, then please take a second to hit that like button. By telling me you enjoyed this topic, it helps me further refine what appears in our future videos. And a quick reminder before I get to the stocks, I'm giving you some good ideas today, but any investments you make are your responsibility. So always do your own due diligence before executing any trade. Okay, on to the stocks. Stock number 1 is UMA, incorporated with the symbol of OOMA, pronounced like Uma Thurman. Sadly, that's where the resemblance ends. But this stock is still an extra special treat because it's also one of my recent additions to the Zen Investor portfolio. That's where I handpick the top stocks for my subscribers and offer monthly webinars, market commentary, and much more. What UMA offers is a modern alternative to traditional phone service. They offer everything from basic residential phone service to enterprise-grade communication platforms with video conferencing, messaging, and security integrations all built in. They're the infrastructure layer that businesses rely on to stay connected. Now, why does that matter? Because small and mid-sized businesses are finally ditching their ancient desk phones and moving to cloud-based communication systems. It's a massive shift that's just getting started, and UMA is perfectly positioned. That's because UMA has built a platform that combines phone service, video conferencing, and collaboration tools into one simple, specifically designed and priced package for smaller businesses. What I'm going to do next is share 3 key reasons why I like this stock, just a quick overview. But if you want to learn more about this or any stock in the video today, then I urge you to visit WallStreetZen.com to learn much more about each of these companies. All right, that includes the full Zen Ratings breakdown for each stock on our quote pages. Just go to www.WallStreetZen.com or scan the QR code on your screen to go there now. All right, back to the 3 reasons I like UMA. Reason number 1, it's a long-term growth play with solid growth prospects. Okay. What I mean by that is UMA has built something special, a recurring revenue business where customers pay monthly subscriptions. But here's what makes it a long-term value play. Switching costs are high. Once a small business has migrated their entire communication system to UMA, then moving it again is very painful. That means strong retention and great lifetime value for each customer. This is reflected in their earnings growth projections currently slated for over 24% year over year. That's impressive because many smaller growth stocks actually burn cash. UMA is already profitable and becoming more profitable quarter by quarter. Reason number 2, it's still a hidden gem for now. In the past 3 months, there have been 2 prominent insider buys from the company's C-suite. Likely they know something about future growth that the rest of the market has not yet picked up on yet. At the same time, Wall Street coverage is limited. Just one analyst we track is covering the stock, and yes, they have a strong buy on UMA. But here's the best part. When the stock is beating expectations like UMA, then they are likely to pick up more new recommendations from Wall Street over time. Each of those events will be a catalyst to push shares ever higher. Reason number 3, the Zen Ratings indicates truly impressive fundamentals. Remember, our model scans 115 different fundamental factors, and UMA earns an overall A rating and ranks in the top 1.2% of all 4,600 stocks we track in our database. When a stock ranks this highly, I next look into the component grades that shape the overall rating. That's because they give the best clues as to the specific strengths and weaknesses of the stock. What's special here is the growth component. It ranks in the top 0.3% of all stocks we track in this category. That's about as good as it gets. But I'm also impressed by the valuation. UMA scores in the top 25% of value based on current metrics. That includes a surprisingly low forward PE of only 12.5. For a company growing earnings 24% a year, you would expect the PE closer to 30. In fact, UMA is also part of our Zen Strategies growth portfolio for this reason. Given the growth trajectory and the valuation disconnect, I sense shares could have significant upside potential. From momentum, the stock earns a modest C rating. This is average, but looking at specific data, I see that UMA ranks on the low side of C on that spectrum. This could indicate the market hasn't caught on to the story yet and could continue to underperform despite solid fundamentals before investors finally start paying attention. But considering all the positive attributes I mentioned already, I think this could be a long-term growth story where we're still in the very early stages. As such, I think it's a strong addition to your watch list right now. All right, hey, if you're liking this video so far and feel like you might enjoy seeing more of them in the future, then it's time to hit subscribe button and the notification bell. That's because I put out these videos frequently, and it's the best way to ensure you see the next one. Moving on to stock number 2 with VTEX with a symbol of, you guessed it. Think of them as the operating system for how big brands sell online. They handle everything from building the store, managing inventory, processing orders, and integrating with multiple sales channels. Why should you care about that now? E-commerce isn't slowing down. If anything, it's accelerating, and VTEX is positioned at the sweet spot. They serve enterprise retailers who have real budgets and real staying power, meaning they're selling to companies that need their software to function. And the fact that they're operating globally with a strong presence in Latin America and Europe, this means you're getting exposure to emerging markets that are still in early stages of e-commerce adoption. The potential growth runway here is massive. That's the big picture. Now, let's look into 3 more reasons why I like this specific stock. Reason number 1, the growth metrics are truly impressive. VTEX is executing at a level that separates real businesses from just hype. For example, over the past 5 years, they have grown revenues by an average of 20% a year. And yes, that top-line growth has shown up impressively on the bottom line as well. But there's another metric that matters too. It's GMV growth, or gross merchandise value. The total value of goods flowing through their platform. That grew 28% year over year. When both revenue and platform volume are expanding these rates is a strong sign that the business model is working. They're not just growing top-line revenue, they're actually processing more transactions and increasing the scale of commerce running through the client's platforms. That's a sign of a company gaining market share and establishing sticky customer relationships. The company also raised its revenue guidance, which tells you management is confident that good times are here to stay. Reason number 2, company insiders are bulking up. It's hard not to notice that a significant portion of the shares are held by insiders. This could suggest management has serious skin in the game and firmly believes in significant upside potential ahead. And reason number 3, the Zen rating smiles in this stock. VTEX is not just A-rated, but actually in the top 2% of all stocks in our database. The component grades reveal even more to like about these shares. Top 17% for financial strength, top 11% for growth, and we're talking about the consistency of growth, which means more likely more growth ahead, and top 10% for sentiment, which says the smart money is already circling around this stock. This is a trifecta of goodness that increases the odds of future outperformance. The one area to watch is safety, where it ranks in the top 30% of stocks we track. Now, that's not terrible, but it's not the best either. As a smaller international play, there is also some currency and geopolitical risk. But for a company with this growth profile and margin expansion trajectory, the potential upside opportunities for shares is very, very compelling. Okay, we have 2 more stocks to go, which brings us to a third stock in Mitek Systems with a symbol of MITK. This is a digital identity verification and fraud prevention company. They authenticate who people are and prevent fraud in financial services, payments, and telecom. Basically, they're the invisible security layer behind digital transactions. Here's why that matters. Fraud is exploding. AI-driven identity fraud has outpaced traditional defenses. Governments are cracking down on this kind of financial crime, and companies are spending billions on security to protect themselves. Now, Mitek has proven technology, enterprise customers with deep pockets, and tailwinds from rising fraud and regulatory pressure that shows no signs of slowing down. Now, for 3 reasons why I like the stock. Reason number 1, the growth story is truly exceptional. Mitek just reported strong Q1 results and raised guidance. Now, analysts are forecasting over 95% earnings growth for 2026. Yeah, 95% growth. Let's get back to that raised guidance found in the Q1 earnings report. This means management is confident the growth story has legs and not just a one-quarter phenomenon. When a company this small is growing earnings at nearly triple-digit rates while raising guidance, it's a pretty good sign of more good times ahead for investors. Reason number 2. Once again, we have impressive insider buying from Mitek. When the C-suite and company leadership are putting their own capital into the stock at these levels, that's a powerful signal. They're not just talking about the opportunity, they're betting on it with their own money. Reason number 3, you guessed it, the Zen ratings is quite favorable in Mitek with an A grade, ranking the top 3% of all stocks we track. What's rare is the combination of the component grades. Mitek ranks in the top 10% for growth and top 17% for value. It's not common to see such a strong pairing, which makes it all the more appealing. Safety is the only area where I'm cautious, which makes sense for a smaller cap growth stock. But when you're looking at a company growing earnings this fast, with heavy insider buying and surprisingly modest valuation, then you have the makings of a position that could deliver serious outsized returns if their execution stays on track. Now, before our last stock, here's something I think you'll enjoy. Every Monday, I share a stock of the week, blending the Zen Ratings quant model with my greater than 40 years of investing experience. So if you want to get these weekly picks for free, then just hit the link in the description or scan the QR code. Let's get on with a truly stellar pick in stock number 4, which is MNTN with a symbol of MNTN. But for our mutual sanity, it's hard to say MNTN, so I'm going to say Mountain from now on, if that's okay with you. You'll be glad you made it this far when I share this. It's a documented fact that a top-rated analyst believes Mountain could see 190% upside potential for shares in the coming year. But we'll get back to that in a moment. Because first, I need to give you the proper setup on this company. Mountain is a performance TV platform. Think of them as the bridge between old school TV advertising and modern digital marketing. They help small to medium-sized businesses run TV ads on connected TV with the same targeting precision you can with Google and Facebook. Basically, it's TV advertising for the internet age. Why is this a sexy idea right now? Because in case you haven't noticed, streaming has all but killed cable. Advertisers need to reach people on Roku, Amazon Prime, Apple TV, and Mountain is the platform that makes that easy and measurable. And we can add AI to the mix too here. Mountain just launched QuickFrame AI 3.0 that generates TV-ready commercials in just minutes. Yeah, that's crazy, isn't it? So here you've got a company operating at the intersection of 3 massive trends, cord cutting, AI, and the shift to performance-based marketing, right? That's the setup. Now, for 3 things I specifically like about this stock, we got reason number 1, the earnings story. Yeah, it's truly explosive. Mountain recently reported record results, and here's the simple version. The company is growing fast, and thanks to impressive margins, is becoming much more profitable at the same time. For example, last year revenue grew 30%, truly exceptional level of growth. Even better is a shockingly high gross margin that hit 82%, helping more and more of that revenue growth hit that bottom line. That tells you the business model is working. They're not just growing revenue by cutting prices or burning cash. They're growing revenue while getting more efficient. The company ended last year with $210 million in cash, 0 debt, and the prospects for even more growth ahead. That's the type of financial health you want to see in a growth stock. Now, reason number 2, insiders in Wall Street are definitely paying attention. So right now, analysts' forecasts for Mountain paint a very optimistic picture. Among the 7 analysts issuing ratings on the stock, over 85% of them have it a buy or strong buy. Best of all is what appears in the price targets, pointing to one of the most undervalued growth stocks I have seen. Even the lowest 1-year price target suggests 85% upside potential from where shares stand today. On the flip side, and as I already shared with you, the current street high forecast suggests over 190% upside potential in the coming year. And these aren't randos, right? These are highly respected folks like Mark Mahaney of Evercore. He's a top 3% analyst based upon his actual stock picking performance, so he knows a thing or two about picking stocks. On top of that, insiders are buying shares aggressively, no doubt showing their confidence in more growth to come. Management is starting to buy, and analysts are excited about the upside potential as well. If that wasn't good enough, then let's roll on to reason number 3, and that is the Zen Ratings has peak excitement about this mountain of a stock. Yeah, I'm really proud of that pun. Here again, we have an A rating, which stands for strong buy. All in all, it ranks in the top 2% of all stocks based on our full 115-factor fundamental review. Now let's drill down into those component grades. In Mountain's case, the standout rating is an A for financial strength, where it ranks in the top 3% of all stocks we track. If a company earns an A in financials, then it suggests the company has a fortress-like balance sheet with strong cash flow generation, minimal debt burden, and excellent efficiency in converting assets into profits. It also earns strong grades for growth, safety, and value. This combination suggests a well-balanced, quality company with solid growth prospects, fair valuation, and predictable operations. These are the hallmarks of a stock that typically have strong and stellar long-term investment appeal. But let's get real for a second. The company earns a D for momentum. For as much growth as they have had, some investors are just not catching on, but to more patient investors. That spells opportunity when you have such an impressive growth and fundamental profile. Okay, there you have it. 4 AI tech stocks, all under 15, all with excellent quant ratings, all with insider buying, and all with exciting upside potential. So, what do you think? Do any of these stocks appeal to you? And why? Or do you disagree with me on any of these stocks? Just leave a comment and tell me everything. I want to hear it all. And if you want more stocks along these lines, then I suggest you check out my recent video featuring hidden gem stocks, all under 35. It's coming up on your screen right now, so go check it out.